One of the most popular investing techniques that's used by many of the most successful stock pickers of all time is finding companies that are trading at a discount. Everyone from legendary investor Warren Buffett to the world's most notorious corporate raider Carl Icahn look to invest in companies that they believe are undervalued when compared to their stock's share price. The key to determining if a company is undervalued is to determine what its intrinsic value is, which is what an asset should be rightly valued at. But you might be wondering, how exactly is this done? How do we know if a stock is undervalued or overvalued? Probably the easiest thing to do is to perform stock ratio analysis on a particular company, which involves simply looking at different ratios that can help investors determine if a company's stock is trading at a premium or if it's at a discount. There's a lot of different ratios investors can look at when analyzing a company, with some of the most popular ones being the PE ratio, the price to sales ratio, as well as the price to book ratio, among many others. At the same time, it's important to keep in mind that not every ratio is used for every type of company. So for example, you wouldn't use the price to sales ratio if you were analyzing a REIT. The reason for this is because REITs earn income from owning real estate properties, not from selling goods or services. Likewise, for some types of businesses, some ratios are more important than others. For example, one of the most important ratios for a business development company is the book value per share ratio, or the BVPS. This is because BDCs issue debt, so knowing the value of all the debt a BDC holds will help determine where a stock should be trading around. But at the same time, just because a stock is trading at a discount doesn't always mean you're getting a good deal on it. To look at one example, one stock currently trading below its value is Annaly Capital Management, which is ticker symbol NLY. On the surface, we can see that this stock is currently trading at a discount because the share price is significantly below Annaly's net asset value, which is an important metric for MREITs. But as you can see, their NAV continues to fall quarter after quarter, and their share price has consistently been going down. So while this stock is on sale, I wouldn't consider it a buy because everything I'm seeing indicates that difficult times are going to continue for this company going forward. It's always important to perform your own due diligence and research before investing in any company. So today what I want to do is discuss a few stocks that are currently trading at a discount according to their financial statements and try to determine if any of these stocks are seriously worth considering. All of these stocks have a dividend yield of over 8% or more, and they're all the types of companies that are required to pay out huge dividends, like business development companies and real estate investment trusts. So without further ado, let's go ahead and get started. The first stock we're going to take a look at is for New Residential Investment Corporation, ticker symbol NRZ. This is a mortgage REIT that invests in mortgage servicing rights, mortgage origination and servicing companies, as well as residential mortgage-backed securities. They operate through several different segments, including orientations, servicing, MSR-related investments, residential securities, consumer loans, and mortgage loans. They've been around since 2011, and right now their stock offers a very generous 8.4% dividend yield. If we look at their balance sheet, we can see evidence that this stock is currently trading at a discount. When we take the total common stockholder equity and subtract the preferred stock and divide it by the number of outstanding common shares, we get a book value of $11.44. Because New Residential is currently trading at $10.57 per share, we can calculate that going by this metric, this company is currently at a 7.6% discount. This was also a stock that was heavily impacted during the pandemic plunge back in March of 2020. It was staying pretty consistent in terms of growth, both in its share price and its dividend distributions for nearly the first 7 years after being publicly listed. But then the pandemic hit, and this stock's share price went all the way from $17.50 per share down to just $3.30 per share. It was also during that time that the dividend was slashed from 50 cents per share down to just 5 cents per share. To this day, it's still recovering, but the dividend is still currently only half of what it used to be before the pandemic. But it still offers a pretty sweet dividend yield of 8.4% as of the making of this video. New Residential is a little more complicated of a company to explain because they're not like your typical mortgage REIT. For one thing, they invest a lot in something called mortgage servicing rights, or MSRs. It would take me a long time to explain how exactly these things work, but in a nutshell, an MSR is when a bank issues a mortgage but relies on a third-party company to collect the monthly mortgage payments. The reason banks do this is because some of them issue a lot of mortgages to people, and it can be a really time-consuming and costly thing to handle all of these loans. So some banks will basically outsource this role to a company that processes mortgage servicing rights, aka companies like New Residential. According to their latest investor presentation, New Residential continues to pursue new ventures by acquiring other businesses within the real estate sector, including Genesis Capital, which provides loans for fix and flips, new construction, as well as bridge loans. They also own E Street Appraisal Management, who manage a network of certified licensed property appraisers. These new ventures help New Residential expand their business portfolio and help cultivate new revenue streams, which I think is a pretty smart idea as long as there isn't a real estate crash coming anytime soon. Next on our list, we have Tcg Bdc, ticker symbol CGBD. This is an externally managed specialty finance company that's focused on providing flexible financing solutions to middle market companies primarily located in the United States. TCG focuses on companies backed by private equity sponsors across a variety of industries that exhibit defensive niche strategies and have sustainable leading market positions. Their specialty is in first lien debt, senior secured loans, second lien senior secured loans, and unsecured debt. As of the making of this video, TCG is currently trading below its NAV, or its net asset value, which is a really important metric for business development companies. It currently yields 8.87%, and when you include the special dividend they just issued along with their quarterly dividend, TCG just paid out one of their largest dividend distributions ever to shareholders. This BDC is managed by the Carlisle Group, which is a multinational private equity, alternative asset, and financial services company. They've been around since 1987, and they're one of several large financial institutions that have created their own BDC, which would also include Goldman Sachs, BlackRock, and Barings to name a few. While their stock is up almost 10% compared to a year ago, its share price is down about $3.50 since their inception. It has recovered and even grown since the pandemic plunge, unlike new residential that we just looked at. Other than that, TCG is a pretty average business development company when we run the numbers. 80% of their debt portfolio consists of senior secured debt, which is good, and their average position is 1 to 2%, which shows that they really seek diversification in their investment portfolio. They pursue investments that are non-cyclical, meaning that they're likely to offer debt to companies that they believe can perform regardless of economic conditions. According to their investment breakdown, 98.5% of their loans are floating rate, which means that as interest rates rise, they'll be able to collect more money from those interest payments. I've personally never invested in this company, and I don't have too much experience with TCG, but it looks like a pretty decent BDC within the sector. Up next, we have Owl Rock Capital Corporation, ticker symbol ORCC. This is a business development company that invests in senior secured or unsecured loans, subordinated loans, and also considers equity-related securities, including warrants and preferred stocks. Owl Rock seeks to invest in growth, acquisitions, expansions, and refinancings. They invest in U.S. companies with an EBITDA between $10 million and $250 million annually and/or annual revenue of $50 million and $2.5 billion. It's owned and managed by Blue Owl, a large specialty finance company that has over $94 billion worth of assets under management. Their stock currently offers an 8.54% dividend yield, and it trades for $14.84 per share as of the making of this video. They pay dividends quarterly, with their last being for 31 cents per share. According to their balance sheet, their book value per share as of last quarter is $15.28 per share, so comparing it to $14.84 per share as its current share price, it's currently trading at a discount. They're still a relatively new BDC, having just launched their stock back in 2019, but they already stand out for a couple of reasons. Despite being a new organization, they're currently the third largest business development company in the industry, according to BDCinvestor.com, and they also have, in my opinion, one of the strongest investment portfolios in the industry. Their debt investments are roughly 90% senior secured debt, with 75% being first lien senior secured and 15% being second lien senior debt. Senior secured debt is always considered to be the safest debt out there, but it's still not entirely risk-free. It's because senior debt must be repaid first if the company that borrows the money happens to go bankrupt. But it's still possible that a company might be so bankrupt that they're unable to pay back any of their senior debt before preferred and common equity shareholders. If a BDC happens to hold less senior debt and may instead hold a lot more unsecured debt or common equity, it's not necessarily a bad thing if the BDC is getting a higher return and they happen to have a lot of confidence in the company they're investing in, but BDCs that hold more equity typically see more share price appreciation, but on the other hand, they also tend to see more share price declines during bear markets. I've talked about this company a few times on my channel before already, so I won't go too in-depth, but for almost a year now, Owl Rock has been my second favorite BDC, behind Ares Capital, which is ticker symbol ARCC. I like the management company behind them, which is Blue Owl, and as I previously mentioned, I do like their investment portfolio. This next stock is one that was trading at a discount when I started this video, but it's now trading at a premium by a few cents, but given it's still, in my opinion, a solid investment, I'm going to include it on this list, so I hope you don't mind. The stock I'm referring to is Penn Floating Rate Capital, which is ticker symbol PFLT. This is also a business development company that seeks to make secondary direct, debt, equity, and loan investments. They seek to invest through floating rate loans in private or thinly traded public middle market companies. It primarily invests in the United States and to a limited extent non-US companies. The fund typically invests between $2 million and $20 million into each business, and additionally they invest in equity securities such as preferred stock, common stock, warrants, and options. It currently offers an 8.91% dividend yield, and it trades for roughly $13.12 per share. Their stock actually pays monthly dividends unlike the others on this list, which is a pretty nice bonus. Penn currently pays a little over 9 cents per share per month in distributions. Their investment portfolio is also pretty decent as it holds 87% secured debt, which is something I like to see. I noticed there's also a lot of media industries for some reason though. I'm not entirely sure why there's 4 different media sectors here, but overall it adds up to 17.4% of their portfolio. I personally consider media along with hotels, restaurants, and travel companies to be higher risk industries. There also hasn't been too much growth in their dividend distributions. The last time they increased their dividend was all the way back in 2014. They've never cut their dividend, but at the same time they haven't raised it in a while. The reason for that is Penn Park likes to target safer investments in order to preserve that dividend. So they don't typically pursue opportunities that could result in higher returns because their objective is to make sure that that dividend remains secure. Their stock also trades pretty close to their original price back in 2011, so no share price appreciation here either. However, if you are looking for a safe, high-yielding dividend stock, Penn Park Floating Rate Capital might be one worth considering for you. And that's going to conclude our look at some stocks that are currently undervalued according to their financial reports. Remember to perform your own due diligence and research before investing in any company. And again, just because a company is undervalued doesn't automatically mean that it's a buying opportunity. A company can have a good reason for being undervalued if they're going in a negative direction, which makes it all the more important to perform your own due diligence. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching and I'll catch you next time. Take care.